Mic check. All right. Hello everyone. This is supposed to be a Bitmex tutorial where I go into a good amount of detail telling you what you should and should not do and what Bitmex really is, as opposed to what people think it is, and how you're supposed to manage your risk, as opposed to say not having stop losses and all of that, right? So how to properly manage risk, how to properly manage your leverage, and how to trade reasonably with common sense leading the way, and you waiting for the trades instead of the trades dictating where you should enter, right? So yeah, let's get started. This is the agenda for today, and we'll be discussing what is Bitmex and why it's dangerous, and what your mindset currently is and what it should be, your trades, and we'll be discussing some fees here. We'll be discussing what kind of instruments you're using on Bitmex and what are instruments by default, and then we'll discuss technical analysis. And essentially what I intend to do is include these points, or rather create sub points within these points, so you can have a document of what this video is about, like a summary that you can print down or you can keep in front of you, that discourages you from making terrible decisions, right? And we'll discuss what you need to do in order to be profitable on Bitmex, right? By the way, we just called this trade a few hours ago, right at the bottom here, and we've rebounded perfectly. We had an inverse head and shoulders, a very clear formation. There was a smaller head and inverse head and shoulders on the 5-minute chart right here, right? And can you guys hear me? Just give me a holla if you can hear me. Put a message or something on Discord. Let's see. Let me just turn the volume to the maximum. Let me know if it's hurting your ears. I'll turn it down. All right, cool. Right. I highly recommend you to give this video to people that are new to Bitmex. They'll have a very clear understanding of what they're supposed to do, and not lose money in the process, especially for people that hear Bitmex is a good place to start trading, when it's really not. It's not supposed to be a place where you just get started with trading, right? It's supposed to be a place where intentionally you lose your money, right? And there's nothing more to it apart from that. So the first thing that you have to realize is that it's tailor-made for newbies to lose money, right? So now in this case you define yourself. Well, are you a newbie or are you not, right? Are you somebody who's new to trading and new to leverage, especially the thing that you can see here, right? Up to 100x leverage. It's apparently a selling point on Twitter, and the high leverage is intended for people that either are 100% confident in their trades or are extremely stupid. And we'll come to what kind of leverage you should use, right? But I'll first go about describing what Bitmex is. So this is a leverage trading platform, a margin trading platform where the settlement is in Bitcoin, right? And this makes it very different from say Bitrex, where you can margin trade, or GDAX, where you cannot margin trade, where you can essentially use Bitcoins to scalp moves itself, right? So you can move in and out of fiat in order to accumulate more Bitcoin or accumulate more fiat, whichever way you're doing it. right? And why is this different, and why is this better than scalping normally? Because this keeps the settlement in Bitcoins, right? And for people, especially for me, this is a really good deal because I prefer it that way. I prefer having my settlement in Bitcoins. And in fact, I'm struggling very hard to take payment in Bitcoins for whatever services I offer, be it graphic design, website design, any other kind of work, even for internships. I'm urging people to pay me in Bitcoins because that's what I want to keep for a longer term, right? A highly volatile and sustainable asset that will most likely outperform other asset classes. But what does this mean for Bitmex? So this platform has gained popularity over the years. It's not new by any means. It's been around, I think, since 2015, correct me if I'm wrong. And it's had a bit of a run, right? It started when Bitcoin was like $1,000. So yeah, without further ado, let's just go quickly into what things you can do with Bitmex. And the most important one is XBT-USD. XBT-USD is essentially the Bitcoin index for Bitmex, and this is something that people don't realize, that XBT is not the same thing as BTC. It simply means that the exchange owes you a certain amount of Bitcoin, right? It's not supposed to represent actual Bitcoin, so that's essentially in their cold wallet, and margin is taken from into your account, right? So what is margin and what is leverage trading? So something you have to understand about leverage is that leverage is when you borrow from the exchange. And what do you borrow it for, right? You borrow it for a position. When you borrow it for a position, right? And this position could be in either direction. So there are two directions a position can be in, or two types of positions you can have, right? And we'll come to leverage and what it is, but I'll quickly explain what longing and shorting is. And I'm just going to draw up an Excel sheet for this. Let's see. And this will be a little better. Excel sheets will be a little better in explaining what kind of trades we take. And this is going to be a long video, so I suggest if you have some coffee, better pour some in and settle down, because you'll gain significant insight into what is going on and what you should be doing, right? So yeah, for example, there is, say, an asset A that is currently priced $1,000, right? Now there are two things you can do to gain money of the volatility of the asset. Say in time span B, the asset goes to 1100, right? So sorry, well, this is pretty close in the case of Bitcoin, but let's say it goes to 1100, right? Say it goes to 1100, right? So what's the difference between these two? So it's simply, let's see, 4 minus, right? So that's $100. That's a gain of 100 rupees, $100, right? It's a gain of $100, right? So how can you make money off this? So one way of doing it is that you buy the underlying asset. So in this case, if you buy A and you buy it at $1,000 and it goes to 1100, right? What have you gained in the process? You've gained a value of $100. Now, how can you realize this potential? You'll have to sell the asset back, right? However, if say there is Bitmex that says, you know what, let's do this. Why do you have to buy the underlying asset? What we'll do is we'll give you these prices, right? And we'll have essentially a contract for the difference of the price. What does this mean? It means that, say for asset class A, and we'll call this XA because this is a contract that is on the basis of the asset class, right? This is not the actual contract itself. Sorry, this is not the asset class itself, right? And for the price of 1000, where A is being sold for 1000, right? They quote you the exact same price and you buy it at that price. You simply buy contracts at that price, right? So each contract, and there are 1,000 of those contracts, so each contract represents essentially a contract between you and Bitmex, saying that at this price we will exchange this contract at the rate you bought it or sold it for, right? Bitcoin's having a bit of a run now. Nice, right after I exited my position. That's cool. That's cool. I exited here and I was expecting a retest, but you know what, Bitcoin, so it doesn't retest. Anyway, so say you buy one contract, right, at that price, at 1,000 on one contract, and the price goes to 1,100, right? At this point, what do you get, right? Do you get $100? No, because you didn't buy the entire asset. You bought about one contract's worth of this asset, right? So that's 1,000 of XA, right? And what do you gain out of this? When you buy this contract, you bought it for $1,000. When you sell this contract, you'll be selling one, right? The point is the percentage difference between these two will give you your profit, right? So that's 1,100 minus 1,000, and we'll have to divide this by 1,000, because remember, this one contract is supposed to represent a small fraction of one asset, right? So you don't have to buy an entire asset. And on longing one contract and then selling it at 1,100, you gained 0.1 of this asset, right? So because there was a 10% difference, you essentially gained 10% of your position, right? So if you longed it for, say, on a margin of 1 MXBT, so let's just term it one contract, and in this case one contract equals 1 MXBT. What is MXBT? This is millibitcoins essentially, right? It's the same thing, and it's represented by like in this way, and you can change it in Bitmex using any of these, right? So you can have it in satoshis. I prefer it in millibitcoin so I can have a very clear view of what because I don't quite trade with a higher amount, I trade with a very small amount, and I keep taking profits regularly, so my position size isn't too big, and if I lose money, I lose a very small amount of it, right? So yeah, this is what happens when you're buying one contract. So for example, if you longed 1,000 contracts, right, and you sold it for 1,100, you would get, at this settlement rate, you would get a profit worth 100 contracts, right? And what does that mean? It simply means that on the asset itself, you will gain 0.1%. Sorry, 10%, right? Fair enough. And that's what this is simply supposed to mean, right? But what is leverage in that case? So let us say that we buy 1,000 contracts worth of Bitcoins, right? So at $1,000, that's one Bitcoin exactly. So let's term this as value and quantity, and rather let's call this margin, right? So the margin is one Bitcoin, right? And when you go to 1,100, you get essentially 1.1, right? And that 0.1 is your profit. Now, what if it went in the opposite direction, right? What would happen? So if it went to 900, so essentially you would end up with 10% less of your position, and this is the position size going against you. You would lose 0.1 Bitcoin in the process on the margin itself, right? So this is non-leverage play, where you are essentially trading at 1x the leverage, and shorting is a different play, very slightly, but I'll come to that. So this is essentially longing, where you're having certain assets, right? So if the trade goes against you, you've essentially lost 0.1. Works? Here is the play on leverage. Say your leverage All right, so let's do this on a slightly different column. Let's erase all of this, right? So your leverage is 100 times, right? And let's term this small x. So if your leverage is 100 times, right? And this means that if there is, say, 1 Bitcoin in your address, right? In your wallet balance, you have 1 Bitcoin, right? Your maximum position size can be worth, at 100x leverage, it can be worth 100 Bitcoins in margin, right? So this essentially is supposed to represent, let's see, this column right here, right? Where if you enter, and I'm going to give you an example of this, I'm not actually going to place the trade. So this is supposed to cost you this much money, right, on that price. Hang on. Right, okay, so yeah, the maximum size you can take on your position is 100 Bitcoins, right? There's a major problem though, because there is something known as margin, and there's something known as margin being used, margin in use, okay? So your position margin can be as large as you want it to be on 100x leverage, right? So this is the margin that you get money for, money against, right? When, say, if you're trading 100 Bitcoins worth of volume, right? But margin in use determines what the margin is in your account that is at risk, right? So that's 1 right now because you're at 100x leverage, right? And you can change this at any time by going to anywhere between 100x to 10x or lesser than that, right? And we'll come to what leverage you should use, but yeah. And this is essentially longing. The final thing is liquidation, right? And the liquidation price. So here's how the liquidation price is calculated, and I'm not going to explain the calculation in detail because it's available if you go to hang on, right? If you go to the XBT series guide, go to liquidation, and all of this is explained right here, right? So liquidations essentially risk your margin, or rather liquidations are the same as margin calls, right? So in terms of forex, for example, a margin call is supposed to represent when your wallet balance is too small to accommodate for a losing position, right? So for example, if we had at 1000 we bought 1000 contracts, right? And how much is that worth? It's worth 1 Bitcoin. But what if the price goes to, say, 500, right? Essentially, your margin size will go to 0.5, and this is a loss of 0.5 Bitcoins, right? But what if at leverage, your margin at cross or the account balance that you had was only 0.01 Bitcoins, right? So here, you would get liquidated far earlier than that, actually. Where would you get liquidated? You would get liquidated at this price, where the price went from, where your size of the position went, the margin being used went from 1 to 0.99, right? Or the size of the loss on margin is greater than your wallet balance, right? On cross, which would mean that you would lose your entire balance in one go, right? So this is one major risk, that you risk losing your entire balance if you're not being careful. And you can minimize this by using isolated leverage. So isolated leverage essentially lets you decide the kind of margin that you want to use, lets you decide your leverage, and lets you decide, how much you want to put at risk. So if I was to, for example, buy one contract at market, right? Actually, now it's not a good time to buy. Hang on. I mean, I can lose 1 cent, right? So if I can go 100x, let's make this a limit order so we lose very little money. And we buy, oops, sorry, just one. We buy one contract, right? What would this do? First of all, your liquidation price would be only 0.01%. I'm going to let this position get liquidated, by the way. So it would be exactly $50 behind the price, because that's how much of a price difference is for 0.01% of the price moving, right? So for on 100x, you would have to be leveraged, or your leverage would be so high that you would get liquidated if the price was to move this much, right? 0.01% of the current price on 100x, right? That essentially is $1 behind. Works. How can you prevent this, right? By not over leveraging. So there are two terms that you need to understand here. Rather, three terms. First is cross leverage, second is isolated leverage, and the slang associated with being on high leverage, known as over leverage, right? So what is over leverage, and we'll come to what it is. When you have too many contracts that are sustainable by your account balance, and the position, or rather the liquidation price is too close, and you know for a fact that it will go to that price. So this is also known as using your entire position in such a manner, in an irresponsible manner, to lose your entire account balance, right? So the first thing that you need to realize is that on cross, your entire balance is being used. Your entire balance on your account, right? On isolated, you get to decide the margin that you're using, right? So we define margin as what is at risk. So in this case, let's go to Satoshi's, because this is too small a contract. So this is what is at risk currently in my account right now. I am 100x plus on this margin, right? So if I was to get liquidated, this is the amount that I would lose, right? And this is on isolated, so it is minimized in this case, and I'm about to get liquidated in a few seconds here. Right, but what if I use my entire balance, right? And the liquidation price will change very dramatically. So you can see that the liquidation price went down to $22. So it's obviously not going in that direction, right? But the margin being used is slightly more. And this is a dynamic margin where, depending on how much the price moves in either direction, I will get liquidated when this becomes equal to my account balance. So I will get liquidated at that price instead of being 100x liquidated, right? So I'm going to keep this back to 100x because I don't want to lose money today. I'm going to lose 100 Satoshis. I think that's a worthy sacrifice for this video. Or should we just close it out? Let's see. You know, for the laugh, I'll let it get liquidated. Right. So at a liquidation, you would essentially lose the money or the margin that was at stake, right? So it is completely up to you to not let that happen. And any other way should not be at risk. And by the way, the margin has increased slightly because I changed my leverage midway in the position, right? That does not cost money, but you'll see what happens in a second here. All right. Now we'll come to over leverage. So if your position size is too big, right? If I was to go say at 10,000, 10,000 contracts right now, I would be highly over leveraged versus the position or rather the account balance that I have, right? How much would I be over leveraged? So let's take into account my current balance. Let's put 10,000 in here. Let's put my entry price at 10. What's the current price? 779, right? So my liquidation would be at 10,330, and that's definitely achievable right now, right? What if I went 100,000 contracts, right? Then I would be liquidated at 10,727. That's barely $70 from this price. Would you do this? No. Is this responsible? Definitely not. And what happens when I get liquidated? I'll lose my entire balance. So this is equivalent of, should be around 465 US dollars right now, right? So you don't want to do that, is it? Hang on. Let's check the value quickly of what I have here. So I went from 0.03 on this account last week to this balance, 0.0465 into 1, 2. That's about $500. So yeah, I don't want to lose $500. I'm not going to let myself over leverage anything, right? And I'm very curious. The price is still oscillating here. It's not bad. Let's close this position out at a very small profit. It will eventually close out. The price would fluctuate enough for that to happen. Right? So over leveraging is when you use too much margin that you have and eventually lose it all. And this is in effect gambling, right? Where you're putting in too much money, far more than you can lose. And I'm out. Yeah, just had in Satoshi value we just gained how much is that? 5 Satoshis. That's not bad, right? On a losing 100x position. So yeah, don't let that happen to you. Cool. So what's next? People underrate this, right? So the troll box on Bitmex is a strange place. It's a place where, well, what do you think of the name troll box? It's for a reason where people give you terrible advice and you listen to it. So here's an example of what happens, right? People get liquidated in very small positions, right? So this is essentially people listening to what people are saying on, oh, by the way, that would have been a really nice position if I kept it. That one-time gambling works, right? So never look at the troll box. That's one thing, because the troll box essentially has terrible advice. By the way, I'm going to put the link of where I trade. That's 1x Capital. I am a moderator there. So you can join us in doing technical analysis and all of that. We do a lot of it on a daily basis. We're never offline, right? And I say this in the most sincere way. There are times when I am on for more than 24 hours a day, or in one go rather, right? So yeah, that's what happens if you put too much money in, right? But this is not the only contract that is there. So Bitcoin is represented by XBT USD. This is the index that they have, right? There are 2 more Bitcoin contracts. First are the futures. So I'm going to quickly see the different things that are on this contract, right? So the first thing that you'll see here is the pricing source. The pricing source on Bitmex, or where the current market price is calculated from, is an average of Bitstamp and GDAX, 2 exchanges, right? When I say average, it's simply a 50%. Adding the 2 and doing a 50% of it is what you get on this exchange. At the current market price, that's about, hang on, this is the mark price, that's 10,823, right, roughly. You don't need to be you shouldn't be concentrating at the 24-hour volume and stuff. The funding. So what is the funding, right? Think of this as maintenance, as a maintenance fee on your position, right? So funding. By default, you are not charged anything if you keep your Bitcoins on Bitmex, right? Nothing. You're not charged anything. But if you're in a position, and I'm going to take the example of this predicted rate versus the position you could have. So let's assume that I longed 100 contracts right here. So at 10,831, I longed 100 contracts, right? So what's my margin? My margin is on 1x leverage. This is my current margin. That's about 9 milli bitcoins, right? So I create a 1x long, essentially a long on 1x leverage, for 100 contracts, and this is what is at risk. So this is the equivalent of 100 contracts at this. This is the equivalent bitcoins, worth $100 at this price, right? What happens at funding? At funding, this price, right? You are charged or back charged, right? A small part of your position. So the funding rate simply multiplied by your position size is the amount you pay for your funding. So roughly 0.009 is the current funding rate multiplied by the current. In this case, what we'd be using is simply make this smaller by 0.0, then we have percent, so that's okay. It needs a copy by value. Oh, it doesn't have that here. Okay, let's just assume this was 0.009 into 0.123 for percent more. Hang on, how much is it? 0.01, right? So that's another 2. Okay, fine. So I was right. 3 zeros. Four zeros. This is the charge you would get on a positive funding on a long, right, against your position. So this would be subtracted from your account balance. Why would it be subtracted? Because what happens is on Bitmex you have a small disparity between the amounts of shorts and longs, because this is not a 1:1 buying and selling exchange, right, where there is not always equal money on both sides. So to equalize that, we have the funding itself, right? In which case, say if you were long for $100 at the time of the funding, you would be paying this much from your account balance in bitcoins, right? There is an upper ceiling and a lower ceiling to this. So the upper ceiling for longs paying shorts is 0.375 or roughly 0.38%, and in the opposite direction is the negative, right? So you can get paid or you can be charged depending on the funding. So the funding can be negative. When the funding is positive, the longs are paying the shorts, right? Where the shorts are getting paid for the positions they're holding. And the funding is negative. When the funding is negative, the shorts get paid instead. The longs get paid instead of the shorts, right? So that's all about funding. The last thing that you need to understand is the taker and the maker's fee. And again, this is very well explained within. If you go to references, let's see, fees. Also, I highly recommend reading this area. So there are two kinds of fees that we have. The first kind of fee is a taker's fee. The second kind of fee is the maker's fee, right? And I'll explain why it's better to be using limit orders instead of market orders, right? So there are, before I go to what fees are, I'll quickly explain the types of orders that Bitmex has. So the first kind of order you'll see here is the limit order. What is the limit order? Limit order is when you get to decide the contracts that you have and at which price you're buying or selling, right? So if I was to buy 100 contracts at 10,000, would I get filled here? I would not, because the price isn't even there and nobody's selling at that price, right? But if the price was to go down to that level, I would be filling in those contracts, right? So that's limit orders. Market orders. So market orders are when market orders are when you are buying at the current market price, right? And this is not going in the order books, and this is something that you need to understand, keep in mind for now. is that limit orders put your order in the order book, where the market order executes simply at that price, right? So it would not be put in the order book, right? So if I was to do, say, if this position is 100 and let's assume this is around 150, if I was to do a market order of 170,000, right, these positions here would all get eaten up because I had a market order that was big enough to execute against the order book, right? Which also means that the price that you close or get at the market, right, it's not static and it's not obvious, because that price depends on the orders within the exchange, right? And this is why this is important. So order fees, right? For limit orders, what you can see here is that well, you just, I think, pause the video and go back. The limit orders essentially take a maker's fee, right? And the maker's fee is always negative, which means that you get paid for contributing orders to the order book, right? Whereas in the market order, you get to pay a taker's fee, where you'll have to pay for having a market order, right? And why is this important? Because break-even trades, right? While a position is going in one direction, what if it comes back and you have to set a close order at that position, right? So you would have to, if you're, say, making 2 orders, right, which ones would you pick in the order of having a long end and closing it? Because when you're selling, or when you're buying, you're longing the price, right? If you long 100 contracts at the current price, for example, and you had a limit order, you would be paid a maker's fee. But if you had a market order that you executed immediately against the order book, you would have to pay a taker's fee, right? Which means that in order to break even, first of all, you have to break even on the fee itself, right? You have to break even on the fees itself. In the case of limit orders, you can rather have a close of your position on $1 above or below your fee, and you would break even, right? And this depends on the kind of order you will have. I'll come to that. But on market orders, you would have to accommodate for the fee you paid, right? For very large orders, for example, 170 or 200,000 contracts, this fee is huge, right? It accounts to almost $200-300 to upwards of $1,000, right? To pay that kind of fee, it's very difficult, right? It's difficult to break even. So in order for you to preserve your profit, you have to use limit orders, right? Keep in mind though, for example, if I had a limit order at the current price 10,779 and I decide to be a little smart and I try to get the highest possible order, what will happen if you place an order for 10,782 here? It would get executed right against the order book itself, right? Hold on 1 minute. Right, sorry for that. Okay, so you would have to, where was I? Yeah. You would have to pay a certain fee to execute against the market. But if you placed a limit order at this price, that would still be a market order because it's executing directly against the market. So you need to make sure that wherever the current price is, the limit order should be above it in the case of a short and below it in the case of a long, right? And I haven't come to short sales for a reason, because I want to explain them in a little bit more detail, right? So yeah, that's all you need to know about fees. In a nutshell, just use limit orders instead of market orders, because market orders cost a lot of money, right? And you don't want to lose out on your profit margin because of that. All right, so the next thing that you need to understand is longing and shorting. So you've already understood longs, right? Shorting is fairly simple. For example, the current price is $1,000 and you were to immediately short sell 1 Bitcoin worth of the price, right? What does this mean? That just imagine it this way, right? What if you sold higher than the buy, right? So this is the same as buying low and selling high, except this is the opposite, where you're selling high and you're buying low, right? And you're going to make money of the price going in the opposite direction of longs, right? Where you gain money, or rather you gain margin, and money is not accurate, but I'll use margin here, where you gain margin for the price going in the opposite direction. So what does this do, right? Say the price goes from 1,000 to 1,100, right? You'd gain 10%, sorry, you went to 900, right? You'd gain 10% here. How would you gain 10%? Because, for example, if you were in a long and the price went to 900, right? And you bought 1.1 and you would essentially be at 0.9. So how is this different from longing, right? First of all, you're selling high, which means that you are selling before you are buying. You are borrowing one contract, or rather 1 Bitcoin from the exchange, and you're selling it off to somebody who's longing at that price, right? And as the price goes down, you will lose, you will gain on that value. So if it goes down to say 500, on your position, you would be up this much, right? Versus somebody who would lose half his money, who would go to 500, right? And the difference here is calculated by the following simple calculation. This is -1 minus 1.5, right? So this comes down to a profit, whereas this simply, in this case, 0.5 minus 1. This in case would be a loss to your margin, right? And that you essentially have gained this much Bitcoin in the process. So when you started with, you had this much Bitcoin, right? But when you ended with the position, you had this much, whereas in this case, this is what you had. So your margin went to 1.5 times while the price went to half its current value, right? Let's delete all of this. Now versus gaining in the price, right? When you're gaining in the price, you are essentially selling it to somebody that wants to buy it at a higher price, right? But when you're shorting, you are shorting it to somebody that is currently buying at a higher price with the expectation of it going higher. So for every short, there has to be a long, and vice versa, right? And the difference between somebody who's going short and long is that the expectation of the price going up or down, right? In which case, this becomes very much like, deciding, or rather gambling in the direction of where the price is going. This is in fact exactly that, right? So whereas in normal asset classes where you're buying A for 1,000 and you're selling at 1,100, you cannot short an asset class because you cannot obviously sell something and then buy it lower on the asset itself. You cannot have, for example, if this was a banana, right? You cannot first sell a banana and then buy one because you don't have a banana. But what if somebody said, a bank said, you know what, I'm a bank, right? And I'll give you 1 banana, you sell it to somebody at that price. And if the price of the banana goes lower, I'll give you 1 more banana. Fair enough? So this is in effect shorting. We're betting against the direction of the current, rather you're betting against the price instead of for it. Where is this useful? For example, you have a current net worth of 1 Bitcoin on Bitmex, right? And this is worth 10,000. Now you're anticipating the price going to, or rather let's make this example a little bit more lifelike. So if you're having currently 1 Bitcoin that's worth 20,000, you're expecting the price to go to 5,000 or 6,000, right? So if you were to short 1x, you would maintain your Bitcoin value, right? Sorry, you would maintain your US dollar value. How would you do that? Well, first of all, you would have a total of this much Bitcoins by the time the price went to 6,000, But keep this in mind though, when the price goes to 6,000, simply these two figures multiplied is 20,000, which means that you never lost on the US dollar value, right? Which means, say, for at this price, if I short worth 500 bucks, which is my net worth at the current price, right? And if the price goes to a certain extent, I will never lose on USD value if I go short. And this is always true, where even if the price goes against you, say the price goes to 21,000, right? This number in that case will totally change. You will, sorry, wrong calculation. Yeah, it goes to 21,000. So this is the number of Bitcoins you would end up having if you shorted Bitcoin at 20,000 and it went to 21. Keep in mind that you never lost in US dollar value, right? Which means that if you were to short 1x at any price, if the price was to go down, you would never lose money in US dollars value, right? Which gives you two distinct advantages. The first advantage of shorting is that at 1x, you never lose USD value, right? The second advantage is that you gain more money, more margin, right? Against, or rather you gain more Bitcoins against your margin, right? And how is this possible? So let's take the real life example. Let's take a real life example here, right? So if you were to say at 1,000 contracts, you bought it at 1,000 and you longed there and you sold it at 1,100, right? What's your gain on this? Your gain is 90 milli Bitcoins. But what if you went short and the price went to 900, right? You see how there is a 1% variation in the direction of your profit. That's what you get from shorting. Basically, if you short, you tend to gain more profit, which means that shorting is more profitable than being in a long, right? Or there's a 10% variation from the mean, in which case between shorting and longing, there's a 20% variation in what you would get, right? While people say that it is not wise to short Bitcoin, I used to disagree with, or rather I used to agree with that. I don't anymore because, well, we've had a bit of a bear market recently, right? And shorting is way more profitable than longing, and this I saw in a real life. I saw as a practice because I was shorting mostly of the way through, and as much as it hurts shorting an asset class that you really like, it's also how you can preserve your capital on Bitmex, right? So for example, if you had only one Bitcoin on Bitmex, but you had 5 Bitcoins in total capital, how would you go about preserving your capital on Bitmex, right? You would short for 5 at 5x margin, right? You would short 5 Bitcoins. Now keep in mind that your current balance is only 1, right? So you could hypothetically get liquidated if the price was to move against you. However, if the price moved in the direction in your favor, which means that the price moved from 20,000 to 10,000, essentially your entire capital is hedged, right? Because you have a short that's protecting your entire capital, and this is the math that people with a lot of money use to protect their capital in Bitcoins, right? So when people say Bitcoin will go to 0, right, you can always short it, and preserve your USD capital value. So if it went from 10,000 to $10 and you were short all the way down, right, on 1x, you would never lose money. So this is something you have to be careful about. The other thing you have to be careful about is that while your liquidation, say if I was to have 1,000 or rather 500 contracts short here, right, my liquidation would be very high. But if I'm in a long, right, my liquidation is essentially current the half price, because at 1x you are borrowing 500, rather you have 500 and you're borrowing another 500 from the exchange, which means that if the price was to go to half, you would lose all your money, right? And this brings me to the mindset part of Bitmex, where I'm going to tell you what you're going to think when you start Bitmex versus what you should be thinking, right? The first thing you notice about Bitmex is it's vastly faster than alt trading, right? It's far more, so to speak, exciting, but it can resemble casino behavior, right? Where, say, if you have one hugely leveraged position that goes in your favor that one time, you will tend to make multiple over leveraged positions, and you will eventually get liquidated at some point. And here's why it's going to happen. I'm going to take an example with statistics here, right? So, for example, if you were to long 100x, 100,000 contracts, and you just had $500 in your account, is that possible? Hell yes, right? You can, at having $500, you can long 500. Well, you can long, how much is that? 500 into 100, right? You can essentially long 500, 50,000 contracts right now. I could do that right now. Do I choose to? No, because I would get liquidated if the price was to go against me, right? Which means I would lose $500. Can I keep putting $500 in and do that every single time? Yes. Will there be that one time where it works? Yes. But what are the odds of that, right? If you're doing your T, you surely know your odds, right? Which is why I have these stupid charts in front of me where I'm trying to predict the price. And it mostly listens, right? So it's kind of like, it's sometimes, it works, sometimes it doesn't. But that still performs far better than over leveraging, right? Where you go into huge positions and end up in losses. So I'll just go to a small channel called, or rather a small handle on Bitmex called, or on Twitter called Direct, right? Where all liquidations are listed. And these are the total number of liquidations that have happened to date. I'm going to show you something that will really scare you. Let's see. So here's a liquidation for 600,000 contracts. Don't worry, there are bigger. Here's one for $1.5 million, approx, $1.3 million, right? Do you want to be one of these people who go super over leveraged and lose all their money? So let's just talk about how much this person lost. Okay, this person lost at least 250 grand, right? On a hugely over leveraged position. Sorry, this person lost a maximum, or rather a minimum of $2,500 on 100x leverage, right? That's crazy. But what if this person wasn't at 100x? He probably lost a lot more money, which is why I highly recommend that you don't over leverage. Highly, when I say highly, just don't do it. It's not worth the headache, right? So first of all, it can resemble casino, where you have to be careful of your own behavior, right? Where, say, if you're in a position and it goes with you and you make 5 positions and all of them go in your favor, right? Is that possible? Is it possible for the 6th one to go in your favor? Ask yourself, what would you feel the 6th time? Would you feel very confident and therefore go in with the bigger amount? The answer is probably yes, because you're not used to this kind of behavior, right? You're not used to leverage trading. The truth is, though, that each of these are separate cases. When you take all of these positions, they're only working because the circumstances were in your favor. The moment luck turns against you, that's terrible, right? And keep this in mind, though. If you're a newbie, the price will tend to go in your favor initially. Like, you'll be very lucky and you'll be making amazing trades. But keep this in mind, though. The moment it happens, there's nothing you can do to stop it. Because once liquidation is done, the money's gone. Just keep that in mind. Which is why I highly encourage you to put only 1% of your total bitcoins in Bitmex, if at all. Because ask yourself, right? We went from, say, if you had the balls to buy the dip somewhere around this level, right? And personally, I bought 8,000 right here, was where I had my first fiat buy-in for the year, right? What stops you from buying at this price and then riding it almost 2 times the way up? This was the most bottom point was 6,000. We're almost at 11, right? So why do you need leverage is a question that you need to ask yourself, and why does it make it better for you in terms of trading? For me, I do both, right? I buy bitcoins and I hold them, and I personally like to increase my net worth over time, which is why I have Bitmex, because I make consistent gains every day. And it's not dependent on my feelings for the day, or it's not dependent on what the market is doing. As long as there is volatility and I can correctly judge it, and both of these things are important, volatility and how much you can judge it, right? Because on a non-volatile day, something like, say, How much of a price difference is this? Well, let's just go to the daily chart, right? On a day like this, for example, right, where the price is not going literally anywhere, you will have to take a break because there is no obvious position that you can enter, right? Especially if you look at this particular day. Right, where did it go? Okay, so if you look at this particular day, there is like very little action, and if you probably caught the top for a short here, that will be fine. But is there something that you have to do on Bitmex in terms of not gaining value? Is it for the fun? If it's for the fun, don't do it, right? Which brings me to my next thing. Sorry. Right, listening to people. Hold on, be right back. Yep, I'm back. So the next thing is that you have to stop listening to people. When you're trading on Bitmex, people will try to, and that could be on Trollbox or in 1x or pretty much any other chart, that people tend to oppose other people by default. You have to remember that, right? And that's also true in technical analysis where there are contradicting opinions. The good thing about 1x is that people here tend to contribute instead of opposing other people's views, right? Personally, myself, I try to look at every chart and try to understand if it's correct or not, which is why I stay on Twitter a lot, because a lot of people post very nice charts and those tend to go unnoticed, right? But for your sense and for your understanding, the more charts you look at, the better, and the more opinions you look at, and that these opinions should be reasonable, keep this in mind, right? The better. And the more people that disagree with that opinion, the more likely it is to be correct, because in Bitmex, right, 90% of the people have to lose money in order for the 10% to make money. And this is true for leverage trading, right? So don't make the mistake of listening to people. However, listen to people that offer genuine advice. Which is what brings me to this aspect. You do not have to be paying people money in order to teach you trading. That shouldn't be the case. More likely, or rather far more, a better use of that money, if you want to really learn, is to give it to somebody that is willing to teach you all of this and teach you the nuances of this for free. Now, have I done this in the past? Have I taught people for money? Yes. Why am I putting this video up? I'm putting it here because I cannot relay this information and knowledge to everybody in one go, right? It's really not possible. B, it essentially gives me one video that I can share with everybody that asks me what Bitmex is, right? So I mean, I can't recommend this enough, and it's definitely for my not for my own sake, because this video is not going to be monetized, right? So please share this with people so they can understand what they're getting into on Bitmex, and only listen to people that, you know what, are while people can be really rude, sometimes they're very honest, which is why you should listen to feedback on your technical analysis. Very important, right? And you should be asking questions all the time. For example, if somebody posts a really good chart, if you do not know how that chart works, you shouldn't be using the chart at all, right? So if you do not understand what an ascending triangle is, you're not going to realize the consequences and you'll end up shorting the top here, right? Which you don't want to do. You have to be smart with your trades. So yeah, listen to people that actually make sense, right? So we've discussed orders and trades. We've discussed how you can, get about fees and all of that. But here's how you can place an order. Limit, simply buy long. Now, there are several options here that you do not need to know. If you really need to go into those, go into detail on Bitmex, just start reading. and this is very underrated. I think you should be reading and watching stuff on trading all the time if you're into trading more than say 1 hour a day, right? Because without it, you're not going to be profitable enough for you to compete with a normal wage, right? Unless you're trading with like $1 million and you can afford making $1,000 a day, right? If you're not doing that, in that case, you should be reading and understanding things most of your time. Anyway, also, by the way, there are a lot of other asset classes. Here, this is just Bitcoin, right? There's Cardano, also known as ADA, where you can trade futures on the basis of the current price of Cardano. So the underlying asset in this case is Cardano. Keep in mind though that this instrument, right? It's only a futures contract, which means that it is settled in Bitcoin. It's a bet essentially versus you and Bitmex on what direction the price is going to go when it settles, right? So if you were to long here and by the end of the contract, the price goes to here, whatever the price difference is, you'll be awarded that many Bitcoins, right? And this goes for all of the currencies here. So all of these are settled in Bitcoin. They're very different in the sense that while Bitcoin is based on the US dollar against the price, all of these are based on Bitcoin, right? Instead of the US dollar. So the base price is dependent on these pairs versus the Bitcoin and settled in Bitcoin, right? So the only thing though is that these have very little liquidity, right? There are very little people buying or selling, so you can't really trade in a very large volume here. So I would, if I were you, I would stick to being close to Bitcoin for the most part, right? You can also trade futures, by the way. What are futures contracts? Essentially, these are contracts that expire a certain date in the future, right? In which case, I'm looking at the March futures right now, XBT H18, right? So this contract expires on the 30th of March, as opposed to this contract in the future that expires in June, on the 29th of June, right? The prices of these contracts can be very different because we're very near to the month of March. The March contracts will have a slightly lower price as compared to the swap contract, right? If you want to understand swap contracts and futures contracts, I highly recommend you go read a few books that I can recommend right now. One book that I can immediately think of is Murphy, that has some detailing on what futures contracts are, right? Probably in the first or second chapter. So yeah, that's about it. The two more things that I want to tackle. The first is the kind of trades and the number of trades you make, right? And here also comes stop losses. So you can place a stop loss like this. You can simply say if you have a long position for 100 contracts, right? So I would type in 100 contracts. Say if my entry price was 10,800, right? And I wanted to put a stop loss. So I would put it at basically at the previous low, right? So previous low was around 10,477. So what is the stop price and the limit price? Once the stop price is crossed, the limit price is put into the order book, right? So for example, if the price goes from 10,773, it goes to 10,500, right? At this point, the stop limit will put my order into the order book, right? So if I was to use it this way, I would be placing a sell order above the current market price or the current price, right? And when will that price trigger? It will trigger when the price goes to 10,500. And then when there's a small fluctuation up, my price will fill and my long position would be stopped out, right? Keep in mind that this close on trigger should always be enabled. So for example, if you only had a long of 100 contracts, right, and you accidentally put 1,000 here or 10,000, let's go in 1,000. So if you put 1,000 here, if you did not have this enabled, you would be opening a position in the opposite direction because you'd be buying 100 contracts and then selling 1,000. Effectively, you'd end up with a short of 900 contracts, right? But if you have close on trigger enabled, as long as the quantity here is equal to or greater than your current position size, you would be stopped out of your position, right? A common strategy that I use is once my position is in profit, I tend to move my stop loss above my entry. So that enables me to say if the price comes down to my entry, I can exit at slightly more than a break-even price, a small profit instead of a large one, as opposed to a loss, right? So there's a stop limit. Then you have stop markets, where it simply stops it out at that market price. So stop limits and markets are the same difference between a limit and a market order, where in a limit order you have a maker's fee versus in a market order you have a taker's fee. So say if I was to put a stop limit, it would not cost me any fee, but if I was to put stop market, it would cost me a fee, right? Then you have take profit and take profit limits. It is my suggestion that you don't use those. It's not directly relevant to what you're doing. Hang on. So if, for example, you had a limit order set and it filled, right? What if I wanted to sell at this price and I wanted to go short instead, right? I could simply put in a trigger price of 10,400, for example, and set a limit price for a sell of 10,500. So the moment the price crossed 10,400, my take profit would appear here, right? And I would be filled and I would go in the opposite direction if needed. The last kind of stop is called the trailing stop, where the price, or rather you can send, simply what will happen is if you are entering at say 10,500, right, for 100 contracts, you would be putting a small trail value, right? So what is the trail value and what happens with it? So say for example the price goes from 10,500 to 10,600. If I had a trailing value of $50, simply that would mean, let's see, 1 second, right? Also let's put this at -500, right? This trail value can be either positive or negative, right? So the price, in the case of my long, if I make a trailing stop loss, what will the stop loss do? The stop loss will be following the current price, right? So for example, if the current price goes from 10,500 to 10,550, if my trailing was at 10,450, it would move to 10,500 once the price moves to 10,550, right? And it will keep following it and so on and so forth. What happens if this price goes to 10,500 again, right? And the trailing stop is also there. Simple, you get stopped out, right? And you can use this to your advantage in case of profitable positions where you want to say, once you've had your take profit, right? Or once it's hit your target, you can set a trailing profit at that level and let the take profit, or rather the position, exit at a much higher profit than it would normally do. So for example, if you had a position of 100 contracts at 10,500 and it went to 10,000, it went to 15,000, for example, right? And you had a trailing stop loss that was at 10,300, $200 behind, and this is how you would make it. You would simply be putting -200 here, right? And the price would be following this the whole time. So the moment the price went to 14,800, and so assuming it went to 15,000, right? And then it went back to 14,800. The limit, the trailing stop loss would essentially stop you out at 14,800 in a huge profit. So your profit would be from here to here instead of from here to your target, which could have been 12,000, right? So you can simply set a trailing stop loss and let your position run the whole time. Now what I want to discuss is the number of trades that you would have to make and something known as the risk reward ratio, right? Very basic trading. So I hope you've understood everything so far. If you haven't, please feel free to tag me in 1x or type in anything in this chat so I can answer those questions that you have, right? So for every trade, right, it is your responsibility to make sure that your risk reward ratio is very reasonable, right? And let's take this for 10 trades. Right, say your position size is always constant at 100 contracts, right? And your risk reward ratio is 2:1 or 2/1 or simply 2, right? Okay, so say you've risked, and this is how it works in practice, right? If I long at 10,700, for example, for 100 contracts, right? I would be risking a stop limit move to 10,500, right? Where you are risking a $200 move in one direction against your against your entry, there's my stop loss, and your take profit could be at 10,900, right? Also, you can simply do this. Instead of having a position close, you can have it auto close at 10,900, right? And you can do this. So see what's going on. First of all, oh, by the way, this should be 10,000. If we're risking $200, we'd be looking for a $400 move to give us a 2:1 risk reward ratio, right? So what we're risking is a $200 move down for a $400 move to the upside, right? So you're risking effectively this move for this move, and you are going to gain 2 times more money if the price should go your direction, right? Where did I make use of this? I made use of this right here. I entered at this price with a stop loss. This was 10,200 with a stop loss at 10,000 roughly. It was at 10,000, right? And I exited at 10,700. It's roughly, well, that was on the futures contract. So this was roughly at 10,550, right? So I risked, this was about $200 for what was more than a $300 move, right? So my risk reward ratio is always more than 2:1. Why does this help, right? So if my position size is constant, my reward is for every 100 positions, 100 size positions I make, I get rewarded $20 and I risk $10 for it, right? For every $20 I risked, right? And my, let's just extend it to this. Say I won my first risk reward. I had a successful win of $20. I lost 20, won 20, lost 20. And this happened 50% of the time, right? Where I won 5 trades and I lost 5 trades. Observe what happens, right? At every time you lost 1, 2, 3, 4, right? How's that possible? Okay, let's do this. Oh, those are 9. Okay, right. Where for every time I won, I got $20, but for every time I lost, I got 0. Or every time I lost 10, right? So observe what happens. First of all, on a constant position size of 100, right, I am gaining $20 every time I win. So for every time I win, I'll add $100, right? So how much is this? This is a total of, right? And for every time I lost 50. What is my position size, or so-called initial, right? My initial was 100. Now on top of the 100, I made, if you subtract my wins minus losses, right? How much is that? Well, that's $50, right? What does this mean? This simply means that even though I was only right half the time, because I had a 2:1 risk reward ratio, my total balance would be 150 in total when I was taking positions 100 contracts large, right? which means that I still went 1.5x on my capital. This makes you an incredibly successful trader. So let's just see how this works for 4 wins instead of 5, right? Where you are winning 80 and you're losing 60, right? So you're gaining 20, and this is what you'll get, and your capital is still 1.2 times. So do you see what happens here? You only have to be right approximately 35% of the time in order to be a successful trader if your risk reward ratio is 2:1, right? Now what if it was 3:1 or 4:1? You'd be risking far less money, you would require a far lower hit ratio, right? And you would still be making money. And you can use this in practice on Bitmex by using stop losses. This is a very common strategy that smart people use, and you have to be smart with your money here, where you are practicing a statistical game instead of a stupid game, right? Where you are calculating everything before you even enter a position. So for example, I was looking for a 2:1 risk reward ratio, right? From 10,200 with a stop loss at 10,000 roughly. I'm expecting it to go to at least 10,600. That's a $400 move for a $200 risk, right? And I still exited right above it. And if I was to do this consistently, every single time, right? Say I lost only 3 trades, 7 out of 10, which is a very common hit ratio or strike ratio for me. Typically I make 7 correct trades out of 10, right? How much do you win? You win 140, you lose 30, right? This puts your win at 110. And at the end of 10 trades, you would be making 110 plus 100. That's 2.2 times your money. Simple, right? So you started with 100, you ended with 210, right? So you can keep extrapolating this to 100,000 whatever trades, right? But first of all, your purpose is to establish a risk reward ratio, right? And you place your stop losses very unemotionally. Once it reaches your target, it's up to you. Do you want to close there, or do you want to keep it open, set a trailing stop loss, and let it run? If I set a trailing stop loss here, I would set it for 100 contracts, which would have stopped me out at somewhere in this region. So it would have been in a profit anyway, right? So it's up to you to decide the risk reward ratio. It's up to you to decide your entry. The game is to keep this above this, right? So the moment this falls below this, it's not really worth it. You can end up making more money in a job if you aren't a 2x trader, right? So yeah, the final thing is technical analysis, where you start guessing what your entry should be, and this is all about technical analysis, where you're assuming where your entry is going to be, right? So it could use any indicator, any type of technical analysis. It could use anything, right? And the crux or the goal is to simply make very profitable trades very nicely by having entries, stop losses, and exits prepared in advance of your trades. So yeah, that's about it for this video. I know I put live trading in the video, but I'm really tired now. This video has been going on for 1 hour 20 minutes, right? And my daily trading time is limited to about 1 hour and about 150 minutes, right? In total, I don't trade more than that. That's more than enough to make 10 trades a day, right? So yeah, stay safe, don't over leverage, be careful, don't listen to people. If you have questions though, feel free to ask me. I'll put my Discord link and everything in the description. So that's about it for this video. Thank you for joining me, and I'm hoping you really learned something, right? All right, take care, have a nice day.